In this webinar, we're going to show you a fundamental analysis method of evaluating a high-quality or blue-chip share. Basically, we're going to teach you how to determine whether it is cheap or expensive at the current price that you're being asked to pay for it in the share market. We're going to teach you how to use a special ratio called a price-earnings growth ratio. Now, to understand that, you first need to understand the price-earnings ratio, which you learnt about in earlier modules. If you're unsure about how the price-earnings ratio works, then you should go back and reread Fundamental Lecture 1, which is headed The 8 Relationships, and make sure that you have got a good understanding of the calculation of an ordinary PE ratio. Now, the PE ratio shows you how many years it would take at the current rate of profits to exactly recover the price that you're being asked to pay for that share in the marketplace. For example, suppose a certain company is trading in the market for 20 Rand a share. Then, if its most recent earnings were 2 Rand a share for the most recent year, then it would take you 10 years at 2 Rand a share to exactly recover the 20 Rand that you're being asked to pay for that share in the marketplace. The PE, or price-earnings ratio, shows whether a company is highly rated or poorly rated by investors in the stock market. Now, investors, what they like most is a company whose profits rise steadily year by year. Their ideal share would be a company where the profits rise by, let's say, 15% per annum every year, and they've done that for many years. Then that share will be highly rated, and investors will seek it, and they will buy it up until the price is very high in relation to those profits. In other words, to the point where the PE ratio is high. Now, obviously, you would expect that that will be reflected in the earnings per share growth. In other words, the growth year by year of the company's EPS, its earnings per share, in percentage terms. So the price-earnings growth ratio, which is the one we're going to teach you today, shows you the relationship between the average percentage growth in a company's earnings every year and its PE ratio. As we said earlier, logically, if it's a highly rated company, the PE ratio will be high. But that means it should also have a very strong, steady growth in its earnings per share over many years. The best way to look at this is to consider an example. Our first example is Sasol. And here you can see I've built a spreadsheet which shows the last 13 years or 14 years of Sasol's earnings per share. And the earnings per share is obviously the profits divided by the number of shares which Sasol had in issue at the time. So you can see that I've got figures here from 2003 right up to last year, 2016. So that's 14 years. You can see that in the first year, 2003, the earnings per share were 1,259 cents, or 12 Rand 59 per share. And in 2004, that dropped quite substantially to 950 cents a share. So that was a 24.5% drop. The following year, 2005, the earnings per share were 1,539 cents per share. And that was a 62% increase on the 2004 earnings per share. And so we go on year by year calculating the earnings per share growth or percentage growth from year to year in the earnings per share. And then at the bottom here, I have calculated an average of those figures. So we've added them all up and divided by 13. Obviously there are 13 years that we can use because the first year we can't use. So that gave us an average of 10.3%. At the same time, you can see that Sasol's current price-earnings ratio in the market today is 9.29. So if we divide that 9.29 by the 10.3%, we can come to the price-earnings growth ratio, which is 0.9. So that gives you an idea. Now, generally speaking, if you look at the price-earnings growth ratio, anything that is below 1 is probably worth looking at. In other words, it might be underpriced. Anything above 1 is probably overpriced. So that's a sort of rough guideline to the PE growth ratio. If you look at Sasol again, you'll see that, in fact, if we just take the last 4 years, so starting from 2013 and moving forward to 2016, then the PE growth ratio increases to 1.15, which is pretty high. That makes the share expensive, whereas at 0.9 we might consider it to be cheap. Let's take another example. Standard Bank. And once again here you can see that I've put down the figures, except in this case we can only go as far as 2015 because that's all the numbers I had available to me. Over that period of time, the earnings per share has grown in percentage terms by an average of 11.3% per annum. And the price-earnings ratio in the market is 10.46, so that gives us a price-earnings growth ratio of 0.93. So the price-earnings growth ratio is calculated by dividing this 10.46 by the 11.3%, which is the average growth in earnings over that period of time. If we look at another company, a very highly rated company, which is EOH, they are in the computer business, and you can see here again I've got figures from 2003 to 2016, and you can see that the average earnings per share growth over that whole period is 27.4%, which is pretty good. And the share, of course, because of that growth, is sitting on a PE of 21.68, obviously much higher than Standard Bank or Sasol. So this is a highly rated company. Nonetheless, if you divide the 21.68, the PE ratio, by the earnings per share, the average earnings per share growth over that period, you're coming to a PE growth ratio of 0.79, which means that even at this high price, it looks cheaper than Standard Bank. Now let's look at Coronation. Now, Coronation is a fund manager. They are the second largest fund manager in South Africa. And here we've got figures for them again from 2003 to 2016. And they have an average growth in their earnings per share of 36.6% over that entire period. The PE ratio is only 14.92. So this company has a PE growth ratio at a very low 0.41, and that indicates that it's actually cheap at this price, at current prices. It's cheap. What you will notice, however, is that in the last 2 years, 2015 and 2016, the earnings per share actually declined in both of those years. So if we just look at the last 3 years, then you'll see that the PE growth ratio is actually 0.55, just looking at those 3 years. And that, of course, is not as attractive as 0.41, but probably a bit more realistic. Now let's look at Capitec Bank. And Capitec is, again, a very highly rated company. The earnings per share on Capitec have risen steadily over the last 13 years, from 2004 through to 2016. And you can see that they have averaged 37.9% per annum growth over that long and extended period. The price-earnings ratio is 23.73, which puts this company on a PE growth ratio of 0.63, which means that this company, despite its high price and its high PE ratio, is nonetheless probably cheap. And certainly it is cheaper than Standard Bank, which is obviously another bank and therefore comparable. Now, Naspers is a company which is well known for its investment in China through its subsidiary Tencent. Well, actually, it's not a subsidiary. It owns about 34% of Tencent. Now, Tencent is specializing in the IT business, in social media in China, and it has a huge client base. The point is that it's got a fantastic growth track record, and obviously Naspers is benefiting from those dividends which it receives from Tencent. So let's look at the figures. Now here I've got figures from 2004 to 2016. So we can only look at 12 numbers, and you can see that over that period it's got an average growth of 64.5%, which is pretty high. But the PE ratio is absolutely astronomical at 76.96, nearly 77. Dividing that PE by the earnings per share growth, we get a PE growth ratio of 1.19, which would indicate that it is really an expensive option at this stage, at this price. And when you're looking at this, you should take into account that the first year, that is 2005, where we could calculate the percentage growth, it was 491%. Leave that year out and you'll find that it's even more expensive. Let's consider the retail shares, some of the retail sector. Woolworths, a very highly rated company in South Africa. Here you can see I've got figures from 2003 through to 2016, so we can do 13 percentage growths and average those percentage growths to get its average percentage growth in earnings per share over that whole 13-year period, and that works out to 18%. The PE ratio is, however, 16.11, which means the price-earnings growth ratio is 0.89. Now, we all know what Woolworths business is. They're into food and clothes. So let's compare them with Pick n Pay. And here you can see Pick n Pay over the last 13 years has got an average earnings per share growth of 11.8% per annum. But their PE ratio is very high at 28.77. And that gives them a PE ratio, growth ratio of 2.43, which in my view is very expensive. Shoprite Checkers, on the other hand, has got an average growth in earnings per share of 21%, and their PE ratio is 19.4, so their PE growth ratio is 0.92. So at this time, Shoprite represents far better value than Pick n Pay. So just to sum up, what you have seen here is a ratio which enables you to compare the percentage growth in a company's earnings per share year by year with its PE ratio. And remember, the PE ratio gives you an idea of whether it's highly rated or poorly rated. If it's got a strong earnings per share growth, you would expect it to be highly rated, and vice versa. By dividing the PE ratio by the average percentage growth in its earnings per share, you can determine whether the PE ratio is justified or not. If the share is cheap, then you'll get a low price-earnings growth ratio below 1. If it's expensive, you'll get a high price-earnings growth ratio above 1. See if you can use this in your analysis, especially of blue-chip shares in the market.